Welcome to AD Finance, and today we are going to talk about hedging. Right now you may ask, why do I have to hedge my portfolio, right? And if you're asking that, then you're completely wrong, right? In the market, even if your portfolio is doing very good, you should always hedge your portfolio. That's the insurance policy, right? Would you buy a house without insurance? No, right? And that's how the stock market works. If you have put in 50,000, for example, in market, then you should have an insurance, right? What would happen if market crashes? How you're gonna save your portfolio? So that's all we're gonna discuss in this video. I'm gonna tell you couple of very important hedging strategies and how you can implement them in your portfolio depending on whatever size of portfolio it is. It applies to any kind of size. If you're interested in that, then please stick around, and with that, let's start. Before we go any further in the hedging, right, we need to understand the concept of beta, right? What beta is, right? So beta, in terms of definition, if you ask, that would be beta measures how much your portfolio moves compared to the overall market, right? So for example, if your portfolio beta is 1, that means your portfolio moves exactly along with the S&P 500, right? Because S&P 500 represents the overall market, right? Compared to that, if you have a higher beta, right, if your portfolio beta is more than 1, that means your portfolio is highly volatile, right? Because it swings higher than S&P 500, right? If it goes in either direction, your portfolio moves how many times of that one, right? So that means you have a higher beta in your portfolio. Same thing is if it is below 1, that means your portfolio is less volatile than S&P 500, right? That means you have a lot of defensive kind of stocks. That's why your portfolio does not move in either direction, right? So now which beta, you may ask, is good, right? Whether you should have a higher beta or a lower beta, right? So the answer is your beta has to be managed well, right? It should not be too conservative. It should not be, definitely should not be very highly volatile, right? So let's take an example, right? Let's say you have Apple, right, which has a beta of 1.2. That means if it moves 20% more than market, it's a bit volatile, right? Tesla, right? Tesla has a beta of 2. That means it moves twice as market. That means it's highly volatile. Now compare that to Microsoft, right, which has a less beta, 0.9. So that means it moves less compared to the overall market. Okay, so that's the beta. Now watch your portfolio, right? If your portfolio is heavy in tech stocks like Tesla, Nvidia, and growth companies, that means you have a very high beta portfolio, right? You need to definitely hedge. Just to give you an example, right? Remember 2022 when market crashed? In that crash, S&P dropped about 20%, right? But if you had a portfolio of beta 2, that means your portfolio dropped 40 to 50%, right? S&P dropped 20%, but your portfolio dropped 40 to 50%. And that's why you need protection, right? And that's where the hedging comes in. So that's what we are going to discuss next. I'm going to tell you the strategies that you can apply to balance this beta. It's all about balancing your beta, is called hedging. Okay, the first strategy, right, which is protective put. That means simply buying a put, right? You buy a put to save yourself from the downside. So let's say, just for example, right, let's say SPY is trading at 450, right? And so what you can do is you can buy 440 put, which is 2% out of the money, for $8 per share, right? And to hedge, for example, if your portfolio size is 50,000, you need about 11 contracts of that. So the total cost is 8,800, right, for a 3-month protection. That's the 3-month, you're buying a put of a 3-month expiration, right? So here's the math how it will work out. So let's say SPY drops from that 450 to 400, right? That's a 11% decline. So what will be worth of your puts, right? So the puts are now worth $1.40 each. So the profit that you're gonna make on the put is 32 and multiplied by the shares, right? If you have 1100 shares, that's the 35,200, right? So your portfolio losses, remember it dropped 11%, so now your losses are 5,500 and the net result would be a profit of 29,700. But that's too good to be true, right? So here's the catch. So if the market does not, this is all if the market goes down, right? You made money because you did over hedging in this. But here's the catch: if the market stays flat or goes up, even if it doesn't go too high, if it just stays flat, you're gonna lose all that premium, right? Because you paid that premium. So this is a good strategy, but you need to balance it. You buy a put, but balance it out, not go to hedging on your portfolio, right? Based on your portfolio, buy a put, but buy smaller. But there is a better strategy than this one, and that's the next one is covered call, right? And this is a strategy which is a perfect hedging plus income generating. So it does both together. It hedges your portfolio and at the same time it generates income for you. So how it works, right? You basically you need to own 100 shares of any stock, and you basically sell call options on those stocks, right? And by selling call options, you collect premium. I have a lot of videos on detailing this strategy in my channel. I will link some videos down in the description. Definitely watch out for that video. Okay, just for an example I'll give you. Let's say you own 100 shares of Apple, right? And that's $180 per share, and you can sell a 190 call that expires in 30 days, and you're gonna collect 350, right? Which is $350 per share. So that's you're gonna collect immediately. That means you're basically, to enter this trade, you are getting paid, right? You're getting paid 350, and if Apple stays below that strike price of 190, then you're gonna keep all that premium. And that's the good part of this strategy, right? You are hedging too and you're getting paid, right? But if Apple goes above 190, you basically you have to sell the stocks at 190. That's the risk you take in the covered call. But still, compared to the put, you are basically, if you're depending on your average cost of Apple, you may still make the capital gain by selling stocks at 190, right? So this strategy is gonna basically generate you income as well as hedge your portfolio. Okay, now the last one, right? And this is a Wall Street strategy. That's the caller. A lot of hedge funds uses this strategy. It's basically a combination of whatever two strategies that we discussed. It's basically how you set up a caller, right? So you set up a caller, you own the stock, you buy a protective put, and then you sell the covered call, right? And that call premium pays for most or all of that put premium. Remember, in the first one you had to pay to buy the put, right? So you are basically offsetting whatever you paid by buying by selling a covered call, right? Because remember, when you sell a covered call, you get paid. So that's the amount you're getting paid, and the amount you pay for buying a put, you're basically offsetting it, right? So let's take an example, right? Let's take an example of QQQ, right? Which is the Nasdaq 100, right? So let's say QQQ is at $380. You buy 100 shares of QQQ for $38,000, right? And you buy 370 put for $12 per share, which costs you 1200, right? And then you sell a 395 call for $11 per share. So that way you make 1100 as an income. So that's your offsetting of that $1200. So your new cost of protection will only be $100. So that means instead of that whole $1200, your effective cost is just $100. So that's what it creates, right? So basically your max loss is just, if you subtract 38,000 minus 37,000, you're basically $1,000 plus your hedging cost, right? But the max gain is 39,500 minus that 38,000, so 1,500 minus the $100 hedge, right? So the best part of this strategy, right, as you saw, right, just with that $100 you have protected your $38,000 position, right? And also you have a upside potential as well of $395. So that's how the institution hedge their portfolio, right? Remember, they have millions of dollars of portfolio, and they do apply this strategy in their portfolio to hedge, right? So that's the strategy that most of the hedge funds also apply. They have a lot of other strategies, but this is one of the common one that they do apply. Okay, next let's quickly discuss some of the mistakes that you can make as a beginner. The first one is overhedging, right? Like we saw in the first example, that's the overhedging. You are buying a put for a lot of money, and remember, buying a put, you're gonna lose all that money, right? Because that's kind of an insurance. So unless you act on it, that's money as the expiration date comes in, you're gonna lose all that money. So do not overhedge. The second one is the time frame, right? Choosing the wrong time frame. So remember, buying the put, if you buy, let's say, weekly put, right? That weekly put is like a lottery. You are next week, you are buying, just giving a week, and you're expecting the stock to go down. You're basically betting that market would go down in a week, right? That's lottery. You don't even know what's gonna happen in a week. So always give yourself little room so that you have time to act on it, right? Do not buy short-term puts. The last one is not having a exit strategy, right? If you do not have the right exit strategy, then you may lose, right? You need to know, let's say you buy a put, right, and market goes down. Don't wait for it, just close that put, take your money out. You did the hedging, you are good. Don't be greedy, just book the profit on that put and move away, right? Stay put and then see how the market reacts, and then make your next move. So you should have a clear exit strategy in your mind before you hedge your portfolio. That was it, guys, for this video. I hope you got some value out of it. If you did, do subscribe and hit that like button. I'm gonna make a lot of videos around options. I already have a lot of videos, but I know there are a lot of knowledge gaps that I see in the whatever videos are floating in YouTube. I'm gonna fill those gaps. I'm gonna make good videos that you can understand. And if you have any questions related to this video or in general in options trading, definitely put your questions down in the comment below and I will respond to that. With that, I'm closing it. I'll talk to you in my next video. Till then, happy investing. Bye bye.